The sun's shining bright on solar. First Solar in particular. The shares soared after the company reported earnings and sales that both beat expectations.
They absolutely crushed those numbers last night. The earnings, the revenue, all of these numbers just through the stratosphere.
This is not about putting shingles on people's homes, one house at a time. This is a wholesale shift, and it's not going to stop.
December 2018. A caravan of black SUVs rolled into a quiet neighborhood in Martinez, California.
3, 2, 1. Execute.
FBI agents fanned out, storming into the home of Jeff and Paulette Carpoff, the husband and wife team behind DC Solar. Inside, they found luxury cars, mountains of documents, and the wreckage of what would soon be revealed as one of the largest Ponzi schemes in American history. Nearly $1 billion had vanished. The victims? Not just everyday investors, but Warren Buffett's Berkshire Hathaway and even the U.S. Treasury itself. This is the story of how a scrappy mechanic convinced America's financial elite to pour hundreds of millions into fake solar generators, and how the collapse exposed just how vulnerable even the smartest players can be when greed, hope, and government incentives collide. Jeff Carpoff wasn't a Wall Street insider. He was a former auto mechanic who had struggled through bankruptcies and failed businesses. But by the late 2000s, he saw a new opportunity: solar energy. The green tech boom, fueled by government tax credits and investor enthusiasm, promised untold riches. Jeff pitched an idea that sounded brilliant on paper: mobile solar generators, trailers covered in solar panels that could be leased out for concerts, sporting events, construction sites, or disaster zones. The promise was irresistible. Investors would buy these generators, lease them through DC Solar, and receive generous federal tax credits. It was marketed as a win-win-win: good for the environment, good for investors, and good for America's push toward renewable energy. Money poured in. By 2011, DC Solar had raised hundreds of millions. The company's growth was meteoric, and Jeff and Paulette suddenly went from struggling middle-class life to millionaires. They built a collection of over 150 luxury cars, bought real estate across California and Nevada, and even sponsored a NASCAR team. Their parties became legendary. One Christmas, the rapper Pitbull performed for guests while DC Solar's employees celebrated their rapid rise. But behind the glittering facade, something was deeply wrong. On the surface, the business seemed legitimate. Investors, many of them Fortune 500 companies, were shown contracts, leasing schedules, and reports proving demand for DC Solar's generators. The government's tax credit system amplified the appeal. For every generator purchased, investors could offset their federal tax liability, sometimes by as much as 30 to 40%. But there was a catch. The trailers didn't exist, or at least not in the numbers investors were told. Of the 17,000 generators DC Solar claimed to have manufactured, at least half were fictitious. When investors asked about their units, DC Solar shuffled a handful of trailers from site to site, giving the illusion of widespread deployment. Revenue reports were fabricated. Leasing payments were often funded not by real customers, but by money from new investors. A textbook Ponzi structure. It worked brilliantly for nearly a decade. Early investors saw returns, tax credits flowed, and glossy marketing materials kept confidence high. Even sophisticated due diligence teams were fooled. The Carpoffs had found a sweet spot: a government-incentivized sector that few outsiders understood, packaged with just enough tangibility, those gleaming trailers, to mask the fraud. By the mid-2000s, DC Solar had reeled in some of the biggest fish in finance. Chief among them was Warren Buffett's Berkshire Hathaway. Through subsidiaries, Buffett invested in tax equity deals with DC Solar, believing it to be a stable, environmentally friendly way to offset tax obligations while supporting renewable energy. For Buffett, who had long been cautious about tech fads, DC Solar appeared to offer a rare alignment: reliable cash flow, government-backed incentives, and an industry poised for growth. His bet was substantial. By 2015, Berkshire Hathaway had sunk hundreds of millions into DC Solar deals. He wasn't alone. Insurance companies, banks, and even municipal entities joined in. The U.S. Treasury indirectly became a victim as well, as billions in tax credits were claimed on assets that didn't exist. The Carpoffs had achieved the impossible. They had conned not only Wall Street's most disciplined value investor, but the federal government itself. As DC Solar's empire grew, so did its excesses. The company expanded sponsorships, funding a minor league baseball team and splashing its name across NASCAR events. Jeff, once a grease-stained mechanic, now flaunted a lifestyle of private jets and $1 million car auctions. But whispers began to spread. Some investors noticed irregularities in lease payments. A few employees questioned why so many trailers sat idle in parking lots. And forensic accountants started to realize that the revenue streams didn't add up. Still, the fraud might have continued longer if not for mounting pressure from regulators. The SEC, IRS, and FBI had begun investigating. In December 2018, their patience ran out. Federal agents raided DC Solar's offices and the Carpoffs' home. What they found shocked even seasoned investigators. In garages and warehouses were rows of rare cars, Chevelle, Camaros, and Mustangs, meticulously restored and valued in the millions. Financial records showed lavish spending, private concerts, jewelry, real estate, and a staggering $140 million funneled into personal luxuries. The house of cards collapsed overnight. Investors were left reeling as DC Solar declared bankruptcy. Berkshire Hathaway wrote down losses of $377 million. Smaller investors were wiped out entirely. And the U.S. Treasury faced the bitter reality that billions in tax credits had been fraudulently claimed, leaving taxpayers holding the bag. The scale of the fraud was breathtaking. Prosecutors revealed that DC Solar had raised nearly $910 million in investments, much of it through false documents and sham contracts. At least $1 billion in losses were tied to the scheme. Jeff and Paulette Carpoff were indicted on multiple counts of fraud and money laundering. In 2021, Jeff was sentenced to 30 years in prison, ordered to pay more than $790 million in restitution. Paulette received 11 years, with a restitution order exceeding $600 million. Several co-conspirators, including executives and outside facilitators, were also convicted. Even an attorney tied to the scheme was indicted years later, showing just how deep the deception ran. For Buffett, the loss was a rare blemish. While $377 million barely dented Berkshire Hathaway's empire, it was a symbolic blow to the Oracle of Omaha's reputation for diligence. For the government, the scandal exposed glaring weaknesses in tax credit oversight, raising questions about how billions in incentives could be exploited without detection for nearly a decade. The DC Solar scandal wasn't just about greed. It revealed structural flaws in America's green energy incentive system. The promise of tax credits created a fertile breeding ground for fraudsters, where complex financial engineering could disguise the absence of real economic activity. It also showed that even the most sophisticated investors are not immune to deception. Buffett's involvement gave DC Solar a veneer of legitimacy that attracted others. If Berkshire Hathaway was in, who was anyone else to doubt the deal? The victims ranged from billion-dollar corporations to small investors and, ultimately, the American taxpayer. The ripple effects continue today, as regulators tighten oversight of tax equity markets and investors grow warier of renewable energy schemes. In the end, DC Solar is a story of ambition turned toxic. Jeff Carpoff began as a man with an idea that could have had real promise, but when reality couldn't keep up with ambition, lies filled the gap. Those lies snowballed into one of the largest Ponzi schemes in U.S. history. At the height of their empire, the Carpoffs basked in the illusion of success. Pitbull performed at their Christmas party. Their garages overflowed with muscle cars. They rubbed shoulders with America's financial elite. But illusions don't last forever. When the FBI kicked in their door, the truth was laid bare. The trailers were fake, the money was gone, and the empire was built on sand. Today, Jeff Carpoff sits in federal prison, serving a 30-year sentence. Paulette is behind bars as well. Their once glittering collection of cars has been auctioned off by the government, raising tens of millions to repay victims, but only a fraction of what was lost. For Warren Buffett, the saga is a reminder that no investor, no matter how disciplined, is immune to fraud. For the U.S. Treasury, it's a wake-up call about the risks of poorly monitored tax incentives. And for the rest of us, it's a cautionary tale. When a deal seems too good to be true, even if it comes with the sheen of green technology and the blessing of billionaires, it probably is. The billion-dollar solar mirage is gone. But its lessons remain. a stark warning at the crossroads of innovation, greed, and trust.